Hello, I'm Jeff Glenn, Senior Vice President with Slatt Capital. And today I'll be talking with Keith Wasserman, a partner at GELT Inc. Keith runs a $1.6 billion real estate portfolio, and he's someone that I have a tremendous amount of respect for. Today he's going to discuss how his company evolved and what they've accomplished in such a short time span. Additionally, he'll be discussing what he's bullish on post-COVID. So Keith, before we get started, can you briefly describe your background and tell us how your vision became a reality?
Thanks, Jeff, for having me, first of all. So I'll tell you guys briefly, I've been very entrepreneurial my whole life. I've never actually had a job. Out of college, I graduated in 2007. The stock market was starting to show signs of distress. Then all of a sudden, boom, the recession hit, housing prices were in turmoil. And my cousin, Damien Langieri, who's now my business partner, came to me with the opportunity to buy a single 4-unit building in the Central Valley of California in a city called Bakersfield. I said, where in God's name is Bakersfield? Us LA people, we don't know where Bakersfield is, but it's a pretty dynamic market based on oil and agriculture around 2 hours north of Los Angeles. And we started our journey in December of 2008 with the acquisition of one 4-unit building that was bank owned. After that, we continued to buy 4-unit buildings, learned the process of renovating them, oversaw raising capital, dealing with the brokers, all the things involved in acquisition and managing buildings. And we started putting together larger and larger syndicates, and we brought in more, we call them the gray hair senior partners, one being my father, another gentleman who's now a mentor of mine, Adrian Goldstein. And we started buying larger apartment communities, traditional apartment communities, garden style, also in Bakersfield, 78 units, 128 units. And we kept growing in Bakersfield till we sort of outgrew that market. We acquired around 350 units there. And in 2009, we were the biggest buyer there. And we said, what's the next market we could target? And that was Phoenix, Arizona. So Phoenix, we acquired around 2,500 units from 2010 to 2015, when really prices were very distressed and people were very fearful. Subsequently, we moved into new markets like Denver, Colorado, Salt Lake City, very early on in this cycle, 2015, 16. And now we've acquired over 8,000 apartment units. Current portfolio sits at around 5,800 apartment units because we've disposed of some. But yeah, it's been a very exciting journey, and happy to talk more about it.
Great. As you tell me this story, I recall how your cousin put the sorts of down payment on your first property on his credit card, which is just amazing.
Yeah, we actually borrowed. We didn't have much money, so we borrowed $5,000 from a friend, and that was the down payment for the property, which was an FHA loan, owner occupied, that Damien lived in. And then Damien got a cash advance of $10,000 on his credit card, and that was used to do the rehab on the unit. So definitely, being an entrepreneur, you got to figure out how to be resourceful and get stuff done.
Yeah, that is truly an amazing story. What year did GELT begin to acquire assets? That would have been roughly 2010, 9. Okay. How many properties exactly have you acquired since then?
We've acquired probably north of 40 properties, but the properties have gotten larger and larger. So we sort of do it by units, around 8,000 apartment units, current portfolio around 5,800. And we've also started acquiring self-storage properties. We have a portfolio of around 600,000 square feet of self-storage. We also acquired 7 mobile home parks and 1 RV park, but we're in the process of disposing of those. And we're also building from the ground up new apartments, around 550 units, all in the LA area in different phases of development. So
is that something new to you, developing?
Yeah, we started building around 4 years ago. My family's been involved in development, but mainly in office, shopping center, industrial, not apartments. So Galena, my wife, actually sort of spearheads most of the projects for us. My father, Steve, spearheads the largest one we have called Watermark, that's on Reseda Boulevard in the city of Reseda in the San Fernando Valley. But yeah, it's definitely a lot higher risk, but a lot higher potential reward. And it takes a lot longer, so you got to have real patient capital.
Yeah. What areas of the country do you focus on?
So the current portfolio primarily is Denver and West. The biggest markets now for us are Denver. We have probably close to 3,000 units there, so around half the portfolio. And then we're in markets such as Albuquerque, Portland, Seattle, Salt Lake City, Southern California. I'm probably forgetting one, but we actually exited Phoenix, unfortunately. And I say unfortunately because values have skyrocketed over the last 3-4 years since we've sold. But we figured it's better to sort of leave a few bucks on the table and then have to go through another cycle there, which has historically been very boom and bust compared to other markets that we're in.
Great. In general, what's the average return for your investors? And I know it's very high.
Yeah, so we never expected this in our underwriting. You'll look, and I think historically we've projected maybe low to mid-teen kind of average annual returns. But on the deals that we've taken full cycle, which are around 15 or 16, we've averaged around 27.5% average annual return, which includes the cash flow, which has been around 8-9% per year, plus the sales proceeds. Hold period has been anywhere from between 1 year to 5 or 6 years. That being said, all these properties we acquired, for the most part, we had long-term horizon. We projected 10-year holds, but the values shot up so quickly because of huge rent growth plus cap rate compression. We felt like, being a newer company, we wanted to create a track record and return capital to investors. Also, whenever we sell a building now, we always do a 1031 exchange, and I'd say 95+% of our investors will participate in that tax advantageous kind of process.
How does your return compare to other companies that manage commercial real estate investments?
Great question. So I've seen returns across the board. It's probably over the last 10 years, it's generally been pretty good as we've been in a strong market, but there's been definitely tailwinds in multifamily, and now I see industrial also being very strong. Also manufactured housing, which we were in, we hit at the right time. We've seen huge dramatic growth in values there because of cap rate compression. But I think our returns probably have been in the highest that I've seen. That being said, our goal is not short-term returns. It's really to preserve people's money and grow it safely over time. And we look more at, when we analyze a deal, what's the anticipated 10-year return going to be on an equity multiple. And we try to hit at least a 2.5 times multiple, which includes cash flow plus sales proceeds. And that's with very conservative underwriting as well.
Yeah, that's incredible. What's your strategy when it comes to debt? So for example, how do you work through large prepayment penalties on properties within your portfolio that you plan on disposing prior to those loans maturing?
Great question. So we've, being a conservative shop, have always usually locked in 10-year long-term fixed rate debt, which has actually hurt us when we went and sold properties. But we did it in order to be able to sleep at night knowing our mortgage payment will be consistent for 10 years. So we were able to generate those kind of returns selling the properties because even though we paid some large prepayment penalties. And nowadays, most of the properties are still, because rates have dropped even further, we are trying to lock in long-term debt. But if we buy a property with a shorter hold period in mind, which is pretty rare, then we'll put in some kind of more flexible loan. We're doing some Freddie and Fannie floating rate debt, also a few bridge loans, but primarily we're still locking in long-term fixed rate debt because we want to build and buy and hold properties.
Okay. So as we begin to see vaccines become available and as the economy bounces back, tell us what you are bullish on in post-COVID.
Yeah, so I'm bullish on hopefully rent collections returning to normal. We've seen some haves and have-nots in the portfolio. The more workforce housing in the blue kind of states have been struggling with collections. Also, there's the ones that are at 100% or very close to it and normal collections still that are more higher end, higher income, higher rent areas. And I'd say I'm looking forward to regular collections, coming back, plus rent growth coming back. Right now, rents have pretty much stagnated, and we're not being aggressive in any rent. We're actually dropping rents a little bit. In the beginning, about a year ago, we saw this coming. We dropped rents on some lease-up projects, and thank God, because leasing came to a halt on some stuff, and we were able to fill up some properties and sort of try to be ahead of the curve.
Great. So now to my final question. In addition to your business accomplishments, can you tell us about the philanthropic work that you've done within the community, which is pretty extensive as far as I'm concerned?
Yeah, no, thank you. So philanthropy has always been a big part of my family, and ever since I was little, whatever I could give, I would give. And as I've gotten older and older, I feel like the more I've given, the more I've received. So we created something called Resident Relief Foundation, which is a public nonprofit, 501c3, where the for-profit or GELT company pays for 100% of the overhead. And what we do is we provide rental assistance for those at risk of eviction due to a one-time financial crisis. So these are responsible renters that have lived in their apartment for at least 9 months. They, generally they haven't had any late payments. We might have waived that recently with what's going on in the world, but we've helped around 150 to 200 individuals and families stave off eviction, stay in their home, and we provide financial literacy classes. We have a lot of volunteers that help with, like my sister is a PhD in psychology. She works with veterans, so she's worked with a lot of these veterans. And we've had some amazing stories where people were at risk of being evicted. They were essentially saved. We have to come in really quickly. We work with large property management companies and smaller ones nationwide who could work quickly with us. And in a lot of cases, they've waived the late fees. And our average grant's been around 1.6 months of rent only, which is pretty amazing because people are pretty resilient. They get back up on their feet. And it's a plus for the landlord who gets to save the costs of eviction, the downtime on the unit, turn costs. It's a plus for society because essentially it's homelessness prevention. We've had around a third of these residents had nowhere else to go. It's a plus for the resident, obviously, because they have housing stability. So that's the big one that we're growing. And I'd like to see, us help thousands, if not tens of thousands of people a year.
That's fabulous, Keith. Well, this concludes our conversation with Keith Wasserman at GELT Inc. And needless to say, what Keith has accomplished in such a short time, along with his contribution that GELT has made to the community, is truly remarkable. And it's great to have him as our guest today. So Keith, thank you. And thanks everyone for taking the time to join us.
Thanks for having me, Jeff.
My pleasure.